been a difficult year. It's been challenging. And I think what's really important to keep in mind is that we want to continue to move forward, have forward progress within our portfolios, make sure that we're positioning for the future and not worrying so much about the current situation.
Welcome to the fourth quarter edition of Barnes Quarterly. We have a little bit different format today for you. We will be visiting with our Chief Investment Officer, Chris Zaccarelli, as is customary. We wanted to dedicate this edition really to what's going on in the economy right now in the markets. We will make available to you additional content from a presentation that Chris gave that really sort of drills down more on, again, the current happenings in the market, as well as what investors should be doing with their money given these market conditions. If you'd like us to send you a copy of that, please just reach out and let us know. On a personal note, we've been staying busy here at the office. We've been attending a couple of conferences to try and help us do a better job with the services that we are offering to you all. I attended a wealth management conference that was sponsored by our broker-dealer, LPL, about a month and a half ago up in Charlotte, and that was very useful. On a more pleasurable note, I took a trip with family out to Colorado and had my first experience with the Red Rocks Amphitheater in Denver, where we were watching my daughter's boyfriend's band, the Future Birds. Just wanted to give the Future Birds a shout out. They were opening for the band Camp, but that was a fantastic experience, and I would encourage anybody that has the opportunity to take advantage of that. I guess the last thing I would add is, as of about 2 weeks ago, we have a 9-week-old lab puppy that is wearing my wife and I out on a daily and weekly basis. But it's fun to have a dog in the house again. Eddie, you've had a couple of trips that took you to some conferences out west.
Yeah, I guess you are experiencing again what it's like to have no sleep. I'm very good at that at this point. We've got a 3-month-old. I think I was actually absent for the last podcast. So recently I was on a couple of trips for conferences. First was a Pacific Life conference in California that was focused mostly on the life insurance side of the business as well as non-qualified business for retirement plans. The second conference was for the LPL retirement partners in Arizona, where we were learning about the latest and greatest in the retirement plan industry, as well as a lot of the new things that LPL is going to be providing for our side of the business. And speaking of the podcast that I was not in attendance for, if you remember, Traylor McNeil was discussing the Hang Tough Foundation. Stan was polite enough to sponsor a team or be a sponsor for that event, and I was in charge of putting together a team to participate in the Sporting Clay event, and we were lucky enough to take second place. Luckily for me, I had 3 really good shooters. I was pulling up the rear. Maybe I'll get some practice in before next year, but we were able to take second place, and I'm wondering, how that actually worked out, because her dad was the one that actually took first.
But we were proud to support Hang Tough. So, as is our custom, we've got Chris Zaccarelli on the phone with us today from North Carolina. Chris, as you remember, is our Chief Investment Officer. And Chris, I'd just like you to talk a little bit about where we've come from year to date for 2022, where we are now, what we're facing, and where we're going to be going for the rest of this year and kind of into next year, as that relates to the stock market, the bond market, inflation, and interest rates. So quite a broad list of topics there for you to cover, but I know you're up to the task.
Absolutely. And again, thanks for having me back. It's great to speak with you on these quarterly podcasts. As far as the stock market goes, clearly this has been a really challenging year. We've dropped as much as 27% at one point and then rallied back a couple of times, closer to down 20% in the stock market. In the bond market, we've gone down, closer to 16% and then rallied back a couple of times. But in general, I'd expect, on average, bonds to be about down around 15%, stocks to be down around 20%, as we're recording this. Really all of it has to do with inflation and interest rates and those topics that you mentioned. Ultimately, with inflation running as high as it is in the 8% levels on a year-over-year basis, the Federal Reserve has made it their singular focus to try to bring inflation back down And so in doing so, they're using really the only tool that they have available to them, and that's interest rates. So they've been raising interest rates all year. In the beginning of November, we're expecting them to raise by another 0.75 of a percentage point, and they're expecting to end the year around 4.5% on the short-term interest rate, and that has had impacts across the entire bond market with 10-year, 20-year, and 30-year bonds all selling off in price and going higher in yield. And so effectively, the Federal Reserve has been driving interest rates higher, and that's been hurting both the stock and the bond markets this year.
Very good. So I think that sort of gives us up till now where we are and why we are where we are. We've been seeing some rallying back in the market over the last couple of days. What's your read on that?
So, markets don't move in a straight direction. It's rare that you'll see the stock market go straight down or the bond market go straight down with yields going straight up. The trend has been lower, absolutely, in both cases. Stock prices down, bond prices down. And so there's been a number of times where the stock market has stopped going back down and then starts going higher again, and then eventually runs out of steam and then heads back lower again. I think we're in the middle of another one of those corrections right now where the stock market ultimately could be headed lower over the next year or two until the Federal Reserve is done raising interest rates. But between now and then, we're likely to see the market rally at any particular time. And that's why it's so difficult to try to time the market and why we don't recommend that people try to do that, because the stock market can go higher at any point in time, even if overall we're in a downward trend, and vice versa. There's always plenty of times where the stock market will pull back even when we're in an upward trend. So right now we're really in a downward trend. The reason for that is inflation is high. The Federal Reserve is raising interest rates. At some point, the Federal Reserve is going to stop raising interest rates. And in the past, they typically would raise to a certain point, potentially cause a recession, and then cut interest rates. In this particular situation, which is different than one that we've seen in the last 40 years, they're more likely to raise interest rates and then do what they call a pause and basically stop at a high level. I don't believe that they're going to cut interest rates anytime soon. So I do believe at some point they're going to have to stop raising interest rates, and that could be in the near future. They may stop as early as next spring, or they may have to go a little bit farther into 2023. But I think at some point in 2023, it's logical that they would stop raising interest rates, leave them at whatever that level might be, and then wait and see what's going to happen to the economy and what's going to happen to inflation. But really, inflation continuing to move higher is a big problem for the Federal Reserve. And even if inflation starts to come back down from 8% to, say, 6% or 5%, that's still going to be too high. So my expectation is that inflation will start coming back down regardless of whether the Fed keeps moving higher. But the question is, how do we get back to 2%, which is their target? And I think that's going to be a longer path and one that we'll have to keep an eye on.
So comment on that for us. What's your feeling about where we are in the inflationary cycle? The economic numbers that are coming out are, of course, backward looking. They're looking at history. They're not looking at what the numbers are today. In fact, we had some economic numbers come out this week. But just talk a little bit about that, if you would.
Well, inflation has moved higher for a number of different reasons. The amount of money that the Federal Reserve has put into the economy during COVID, the amount of money that the federal government has put into people's pockets in terms of government programs during the pandemic, and then the fact that there's been supply chain shortages and then energy shocks in Europe due to the Russian war. And so there's a lot of catalysts for higher inflation and the necessary and sufficient conditions for inflation in terms of increased money in the system. And so that's all going to take time to work its way through. Certain parts of the inflation problem in terms of supply chains and higher energy prices are in varying degrees of being worked out. And I would say the supply chain problems are not perfectly resolved, but we're much farther along in terms of that being a cause of inflation. It seems like for the most part, supply chains have reordered and have started to adjust. We do have the issue that China is still undergoing a COVID zero policy where they continue to shut down production whenever they have small outbreaks. And so that will continue for supply chains around the world as long as China pursues that policy, which it looks like they will continue to pursue. On the energy side of things, I think it's a little bit more mixed. To some extent, you've seen natural gas prices come down quite a bit from the highs of this year. And likewise with oil, but we continue to be undersupplied in terms of fossil fuels, and we continue to see higher demand. So I think as far as the energy component of inflation, that's likely to be a little bit more sticky. And then the last piece is really consumer demand. And so you could argue that as long as consumers have money in the bank, have jobs, continue to earn income, they're likely to continue to pay the higher prices that we've been seeing. I don't know that the consumer will continue to pay 8% higher prices every single year, but if prices are up by 4 or 5% every year for the foreseeable future under the current situation, that wouldn't surprise me. So ultimately, I think if inflation is truly going to come back down to the Fed's target, we're probably going to have to see higher unemployment and/or a recession in the traditional sense, not just in the academic sense like we saw earlier this year.
Chris, Stan and I were actually talking to a wholesaler earlier today, and he was talking about the post-election effects on the market. We typically tend to see more stability and certainty after these midterm elections, which tend to have a positive effect on the market. Do you see us receiving much of a bounce from the election, or is this market going to be strictly driven by the interest rate and inflation?
That's a great question, and I think we are likely to see the typical patterns persist. So, as you mentioned, typically in a midterm election year, and this is one of them, the stock market will rally either into the election or continue rallying after the election. And I don't see any reason why that wouldn't happen this year. The stock market has sold off quite a bit. I think there's a lot of anticipation to what the results of the midterm elections will be. And I think we're likely to see the pattern of the stock market going higher into the election, which is what we're seeing so far, and potentially through the election. There's a couple patterns that will typically happen, what they call seasonality in terms of the end of the year. We typically see November and December be up months, and also every 4 years during those midterm elections, we also see the stock market move higher. I don't see any reason why those two trends can't persist, and that's why we are likely to see the stock market move higher, at least in the short run. I think ultimately over the course of the next 1, 2, 3 years, inflation and interest rates are going to continue to be the dominating force on the stock market and the bond market. But at least in the short term, we could see the trend go higher, and that's why I'd be careful to predict which way the stock market's going to go in the short run, especially because there's so many cross currents right now.
So I've got a kind of a two-part question for you. You mentioned what's going on overseas, specifically in the Ukraine, obviously China. I don't think we ever really know what's going on in China just because they're so tight-lipped about what's going on. But their economy, I think, beat estimates in terms of how they're doing over there. But historically, I know that international investments have been a place that have provided a lot of opportunity for investors. Right now, with the current situation, what is your take on potentially investing overseas, number one? And number two, in the domestic markets, with the rally that we've got going on, I'll call it a rally. A couple of up days don't necessarily constitute a rally, but maybe this rally going into the elections provides an opportunity to reposition some portfolios. And if you're doing that, what sectors are you looking to go into?
So taking that two-part question one at a time, from an international point of view, it typically does make sense to be diversified. Clearly we're all U.S.-based investors, dollar investors, and so not surprisingly, the vast majority of our portfolio is in the United States. And I'd recommend that. I think it makes sense to have a majority of your investments in the United States spread across large companies, small companies, mid-sized companies, but ultimately have, a pretty robust U.S. investment process and portfolio. However, it does make sense to have some international exposure. There's a lot of great companies that are not in the United States. 50% of all economic activity happens outside the United States, and there's always parts of the world that are either inexpensive or fast growing, in some cases both. So on the one hand, there's always a lot of opportunities outside the United States. On the other hand, I think it's important to make sure you have the right percentage of your portfolio outside the United States. So with that being said, I think there's a lot of opportunities within some of the more recession-resistant sectors, let's say in Europe. So whether that's consumer goods, whether that's some healthcare companies, large multinational companies, similar to what we have in the United States, there are a lot of companies in Europe that fit that bill. Additionally, I think, China is a place where there's a lot of risk. Clearly, there's a lot of political risk, there's been a lot of friction between the United States and China. And so while I think China is still a really big growth opportunity, again, I think you have to balance the risks with the growth. So I wouldn't say you can't invest in China, but I would say if you were going to invest in China, I would do it in a smaller way, not necessarily as large a part of your portfolio as you find in the rest of the world. So it's really going to be balanced. There's parts of Asia, there's parts of Europe, there's parts of emerging markets, all of which I think are priced very attractively, and a lot of those places have good growth. So I think, depending on your risk tolerance and depending on, what your portfolio objectives are, it does make sense still in the current environment to be diversified to some extent and to have those investments. As far as reallocating within the United States, I think it's going to be really important to have inflation hedges in place. That's something that we've been adding to the portfolios really over the last year and a half, and I think it's still not too early I still think it makes sense to maintain those hedges. So whether you're talking about commodities, energy, materials, I think companies within those sectors and having exposure to those areas are still going to make sense in the coming years, because as long as inflation is a threat, let alone an actual problem, I think those parts of your portfolio are likely to hold up pretty well. Outside of inflation hedges, it really depends on your time horizon. In the short run, if we get a big rally, you are likely to see, industrials, financials, more cyclical sectors do really well in the short run. And so I think it makes sense to have some exposure in those areas. But I do think we are going to be facing a more severe recession over the next couple of years. And so it's impossible to know what the path will be in order to get there. So I don't know that you can necessarily begin preparing for a recession immediately. But I think at some point it makes sense to have some parts of your portfolio that are a little bit more resilient through recessions. So again, looking at healthcare companies, looking at companies that are more needs rather than wants. And so, again, looking at things that are more consumer staples rather than consumer discretionary, the types of things that you would continue to buy through a recession, as opposed to things that you'll buy in the good times but maybe cut back on in the more lean times. And I think that's something to keep in mind as we move forward through this economic cycle.
Very good. Well, any parting words of wisdom for us before we let you go?
I mean, I'd really like to sum it up by saying, listen, it's been a difficult year. It's been challenging. And I think what's really important to keep in mind is that we want to continue to move forward, have forward progress within our portfolios, make sure that we're positioning for the future and not worrying so much about the current situation. And by that, I mean, when the stock market goes down, there's always opportunities to buy really good quality assets at a discount. And as the stock market eventually recovers, which it will, you'll see the benefit of sticking with the plan through the entire market cycle. So there are some silver linings to what's otherwise a difficult environment, in the sense that what we do now during these times will set us up for future success. So regardless of how cloudy things may seem in terms of the stock market or the bond market or some of the doom and gloom maybe you read in the newspapers or hear on the news, I do think there's a silver lining. I'm very confident we're going to make it through this environment. And I think staying the course is really what provides those better long-term returns. And for those clients that have been with you a long time, they've seen that through multiple crises. And so this isn't the first time they've seen the stock market go down by 20% or more. And potentially it won't be the last time. Hopefully we all live a long life. And unfortunately, if we do, then you will, fortunately, if we do, you're likely to see other pullbacks in the market of similar size in the future as well. Like I said, the stock market doesn't just go up in a straight line.
Well, very good. Having been through a couple of these difficult markets, doesn't really make it any more fun the third or fourth time around, but at least hopefully we have a little bit better understanding of what we're facing and can see that there is light at the end of the tunnel. So thanks so much for being with us this afternoon and all you do for us and our clients, and hope you have a good afternoon.
Thanks. I really appreciate it. It's great speaking to you, and I'll speak to you again soon.
So we're a couple of days from Halloween and we're moving into the holiday season. So this will be the last podcast for this year. But we just wish you and your families a safe holiday season. We hope for calmer waters in the capital markets, and just have a great rest of 2022.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.